Is this Willie the jackass, or is it Ben Franklin?
It's Jim Willie trying to pose as Ben Franklin, but I'm a lot less fat.
Welcome to Shadow of Truth, and today is Thursday, July the 30th. And what you're about to hear is a recording that we did on Tuesday, July the 28th, with Jim Willie, who is the editor of the Hat Trick Letter that can be found at goldenjackass.com. You're going to hear a couple of sound bites to give you an idea of what the show entails. And I can assure you that this is going to be one of the better Jim Willie, if not the best Jim Willie shows that you will ever hear. He is absolutely on fire, and I'm not going to take up any more of your time. Certainly appreciate everybody listening and watching. So thank you so much.
We're to the point now. This is really ugly stuff. We're to the point where politician calling cards are treason and genocide. Position where we're going to permit the financial sector to rise and rise while killing the rest of the economy.
Welcome to Shadow of Truth with your host Dave Kranzler from investmentresearchdynamics.com and Rory Hall from thedailycoin.org. And we are honored and thrilled to have returning guest, the editor of the Hat Trick Letter, found at goldenjackass.com, or I should say, Dr. Jim Willie. How you doing, Mr. Willie?
I'm doing fine. It's a funny thing about the doctor. When I started my career in the Boston area, I put on my business card the PhD, and in 1 year I removed the PhD from my business card. It caused problems. It caused some very weird problems. For one thing, it led people to believe that I would therefore never commit an error. And it led many people to believe that maybe I shouldn't be brought into a discussion because I would embarrass everybody with a higher level of, I don't know, information, intellect, analytic ability or whatever. I removed it, and my boss said, "What the hell are you doing? You ordered new business cards without your PhD." And I said, "It causes problems from all you people." And later I told him some of the details, and he said, I see what you mean. Okay. Anyway, I don't like using it, but if you mention it, that's fine. I worked my tail off for 5 years to earn it. 3 extra years after the Masters. Well, 2.5, really.
That's the reason That's the reason I mentioned it.
That not a very large percentage of the people of the world have been able to achieve.
Exactly, it's noteworthy.
So Jim, I heard that you got an interesting note from Hugo Salinas Price back in May. Do you want to tell us a little bit about that?
Yes, he's a client with the Hat Trick Letter and has been for about 3 years, I believe, maybe a little longer. And he's actually done something that no other person has done. He said, this happened back in 2013. It was 2 years ago because it had renewals. He said, "I have 3 friends and colleagues that I want to buy Hat Trick Letter subscriptions as gifts. One's a banker, one's an economist, and another is just a good friend who has his own personal wealth that he's managing." No one's ever done that. So he's a unique fellow, but the message that was received in May was disturbing. I know that for the last few years he's been involved in a movement in his native Mexico to install a Mexican silver peso standard. In other words, a precious metal backing behind their currency so that it breaks away from the U.S. and Western-led fiat floating toilet paper currencies and the Forex. And the message was really simple. It wasn't a long message with a concluding disturbing line. It was a simple message. Jim, if you don't hear from me in the next few months, I might be in trouble. I think they're trying to kill me for my efforts with a silver currency. That's all it was. And I wrote him back and said, gosh, what happened? What are you working on? Is it just the Mexican currency? Is that the Mexican peso work that you're getting the scrutiny for? And there was no reply. So I think he might be perhaps working behind the scenes on some projects, but at the same time going into a little bit more of a state of seclusion. I don't know. I've not received a message from him since. We usually communicate when there's some little snag on renewal of one of the 3 subscriptions. I mean, there's some funny things that have happened with the free gift subscriptions. One guy wrote 3 months later and said, I understand Price gave me a gift, but I don't know how to log on. And I gave him an email. What am I supposed to do? I gave him an email to start. I asked Price, make sure he gets the email. You have better contact with him. Anyway, so we contact each other on renewals, but that means every 6 months and not staggered because they were all in a group. I don't know what he's doing. I've heard from others that maybe he's been involved with the Greek drachma behind the scenes project because the rumor has it that they're more interested in a silver-backed drachma than a gold-backed drachma. And I recall my history of money learning that back 1000 and 2000 BC, way back, the Greeks were the first civilization or empire, if you will, to have a precious metal-backed currency that was silver. So they had an enormous mine that they mined in Greece for, I heard, years and years, like 50, 80, 100 years. I don't have the exact information in front of me, but it produced the money, it produced the capital for, business investment and maybe, going out and capturing a nearby country and offering them silver to their leaders in order to be part of a greater system. I don't know. So maybe Price was involved with some Greek drachma, new silver-backed project, and that was the basis of a threat recently delivered. I don't know. He's not answering his emails. I think he's lying low.
It's interesting because we had contacted him probably late May about coming on the Shadow of Truth, and he agreed to do it. And then, literally, like the next day, he said, "Look, I've got a lot of stuff going on right now. Let's do this later in the summer." And ever since then, he has been kind of laying low. I mean, I haven't seen anything published by him in a couple months. Have you?
No, I haven't. He has posted many times on goldeagle.com, but I have not seen anything in a while.
Yeah,
but I don't go out looking for it though. I don't do a search of his latest work. To be honest, I've got 30 different people sending me things all the time. Not just my 8 or 10 colleagues, but they're 4 or 5 real strong, what we call news hounds, and they send me stuff. And I have numerous clients who send me stuff and say, "You'll find this interesting," or "What do you think this means?" or attaching a direct question with specifics. But I haven't seen anything in my inbox for a long time, and I don't know what he's up to. I don't know. I hope he's doing well. I'd like to see Mexico relieve their problems because for the first time in something like 30 years, their currency is down to 16 per dollar. And for the longest time, it was between 10 and 12. So they're having a currency implosion. But at the same time, the elites, the big banker cabal, whatever you want to call them. I call them the financial crime syndicate, the banker cabal. They threaten anybody who tries to offer a solution in the form of a precious metal-backed new currency, because it's, opposes the U.S. dollar and our way of life. Well, what is our way of life? Banker fraud, war, military contractors, genocide projects, undermining foreign governments, forcing them to move their gold, killing leaders and just securing their gold, like Gaddafi. He had 144 tons of gold, by the way. Now, that country, Libya, will never. Yeah, well, I was going to say the country will never see that 144 tons again.
And they relieved Ukraine of 31 tons as soon as that whole thing started, or 33 tons. 33 tons, and that's part of what we're going to discuss here in our list of questions. That event delayed the reset. The global currency reset was scheduled in early 2014. The Ukraine war interfered with all that. So, when people ask me when, I say, well, do you know if we're going to offer a new war?
Well, Jim, that confiscation of Ukraine's gold was extremely critical to what the U.S. was doing, because it was kept so quiet. I mean, the gold investing, or if you want to call them gold bug community, harped on it for about a week. It was never mentioned in the mainstream media, and then it just disappeared. I mean, no one talks about it now. So to me,
I know.
It was basically covered up, and the whole topic sort of died away after about a week.
Well, not only did that die away, but the $5 billion that the U.S. government invested in the Kiev regime change, that story also went away.
That disappeared too. I mean, no one wants to acknowledge the fact that we have Victoria Nuland on tape talking about the fact that we put in a puppet government there and spent $5 billion to do it. No one mentions that. Everyone says it's Putin's fault that there's something going on in Ukraine.
Well, there's a new narrative. There's a new propaganda narrative that we're supposed to march to, but I don't.
So there's one, speaking of propaganda, and I think it ties directly into what I see is not just a collapsing global economy, but specifically and especially a collapsing U.S. economy. We've seen commodities just fall like a rock. And we also saw this happen in 2008. And it's not just crude oil. It's just about every industrial commodity and many agricultural commodities. What do you think the message is with respect to the U.S. dollar and the economy?
Well, I think to begin with, we're looking at a phenomenon now where the dollar is rising because the crude oil is falling, and they're tied together with dismantled Petro-Dollar derivatives. If you want to speak in layman's terms, just say, well, the Petro-Dollar standard being taken apart, it's going by the wayside. But if you want to get technical, you have to look at the details in the complex derivative contracts that link the many Forex paper currencies, namely the dollar, the pound, and the euro. There are big, complex contracts that have held together for over 40 years. The paper currencies linking them to the crude oil price. Something happened in around middle of 2013. I offered considerable analysis and details for this phenomenon 2 years ago in the Hat-Trick Letter, because I was noting significant changes between the relationship between the United States government and the Saudi royal regime. You were hearing lots and lots of nasty comments coming from King Abdullah. And Abdullah was weak and rumors were that he was, on his deathbed for the longest time, and there was a battle for succession with the crown prince and the other, inbred, pathetic candidates. And there was a lot of battling because Abdullah had 23 wives and lots and lots and lots and lots and lots of kids to battle for the throne and to challenge the throne. And at the same time, do you remember the story about UBS and the U.S. government going after them for, money laundering and illegal tax dodging accounts and all kinds of things at UBS in Switzerland?
Yes.
Okay, that was related. I know I'm taking the scenic route here on the commodities falling question, but back in 2013, the U.S. government wanted to take control of UBS, and they decided, well, the best way to do that is to come up with some formal charges. So they came up with some Mickey Mouse charges that stuck. It's not hard to prove that UBS was doing tax dodge accounts. It wasn't hard to prove that they were doing some intermediary work with Iran sanctions bypasses for funds. Why do they want UBS? Why do the U.S. and London bankers want UBS control? Because that is where a significant amount of Saudi gold was stored. And we stole it. Okay, I got wind of that from my gold contacts who knew what was going on with respect to the Swiss banks. I'm not talking about Swiss commercial banks. I'm talking about the Swiss bullion banks, and UBS had tight linkage with some of the bullion banks. And the whole thing just repeated with Credit Suisse and PNB Paribas, more Mickey Mouse charges in order to do two things: get the rest of the Saudi gold and interrupt PNB Paribas being used as an intermediary by the Russians for dumping treasury bonds to buy gold. So all three cases of UBS, Credit Suisse, and PNB Paribas had a gold angle, and none of the angles were reported in any of the stories related to those three major banks of Europe. Okay, so there's a lot of interference. The reason I bring up all the UBS and the Swiss and the gold with respect to the Saudis is that in 2013, I actually came out and said the petrodollar is going to be trashed. And we're seeing indications of it right now in the middle of the summer months of 2013. Look for a grand and ugly divorce between the U.S. and the Saudis. And now we're seeing all kinds of stories about ISIS and ISIL, which is the same thing. It's the Islamic State of Syria combining with Iraq and the Levant. Levant is just the L for a region. It's like a tribal region in the Middle East there along the Mediterranean. But we got some extraordinary things going on with Obama admitting that he is both funding ISIS and attacking ISIS, which confirms my point that I've been making for a solid freaking year. The U.S. government created ISIS because we could not control the Iraqi parliament and their Shiite connections. All right, so back to the question of falling commodities. The petrodollar standard is being dismantled. And in its dismantled process, what you have is lots and lots of enormous multi-billion-dollar contracts in Europe, London, and New York being liquidated. And when they get liquidated, the owners of the contracts are paid in dollars. So there's your dollar demand. And we're not talking about a little bit of money here. We're talking about trillions. So we have trillions in hidden paper-based derivative contract dissolution. They're dissolving these contracts and creating a mammoth mountain of dollar demand. And that's lifting the dollar in its exchange rate, relative to all those countries where the people are standing for their liquidated contracts. In other words, if you're talking about a German or a French or an Italian bank that's involved with a derivative, they sell the euro to get the dollar. So down goes the euro, up goes the dollar, and this explains why the euro is heading down to 100 parity. It's from the dismantled Petro-Dollar standard. And if people tell me, oh, Jim, I think you're exaggerating this Petro-Dollar effect, I ask these morons, and rarely get an answer back, I ask these morons, well, in 71, when Nixon abrogated the Bretton Woods and gold contract standard, what replaced it? It's the petrodollar that Rockefeller, through his Kissinger agent, went over to suggest. It was not the Arabs who did it. The Arabs agreed after Kissinger suggested the fourfold increase in the oil price. Get that straight. 1973 oil embargo by the Arabs involved a fourfold increase in the price of oil, suggested by Rockefeller's agent named Professor Heinz Kissinger of Columbia University. Why was he selected to be Secretary of State under Nixon? Because he's a Rockefeller boy. They don't ever discuss Kissinger's roots to Rockefeller as a paid agent, nor do they ever talk about Kissinger's dozens and dozens of trips to South America to visit the most ugly of the fascist regime leaders in that continent. But you do get hidden pictures that come forth. So we have a lot of things going on, and I think the big time kick in the nuts is going to be the Saudis turning around with some more vengeance and accepting Chinese RMB for oil payments. I mean, from China, from Japan, from Korea, they're going to accept RMB. And Iran, the same. So Iran and Saudi are going to have something very big in common soon in accepting for oil payment Chinese RMB currency. This commodity falling price index, it's really astonishing because, you know, when you look at the reaction to QE, the QE is the unsterilized Federal Reserve bond monetization purchase program. The reaction by some governments and a lot of really well-heeled financial firms is, well, let's hunker down into some tangible assets like, say, oil fields or copper mines or commercial buildings or farmland or gold, silver, mining firms for gold and silver. But now when the commodity hard assets are showing pain, to me, it means we're in the last stage of the dollar collapse. And I've been saying this now for 3 years. You'll know the dollar's about to die when it rises, and then rises some more, because it's soon going to vanish. Now, people tell me, when's the dollar going to crash? I say never. It's going to vanish. Don't get me wrong. I don't say it's going to rise, then suffer a huge fall. Nor will the Treasury bond rise, and suffer a huge fall. They're going to suffer a vanishing act from global rejection. Big difference. And I don't think even a third of the people who hear me understand what I'm talking about. The dollar's going to vanish because foreign nations and producers are going to say, we want to ship product to the U.S. economy, but we don't want your stinking toilet paper called Treasury bills as payment. We want something better. We want, for instance, RMB or gold. And the U.S. is going to say, whoa, wait a minute. You're now a rogue nation. We're going to have to declare war against you. And there are going to be so many nations that say this, that the United States is going to be exposed as a warmongering defender of a toilet paper dollar currency that's wrecking the world. The US dollar is now toxic currency. Some of the most sideways queer looks I get from people come from when I say to them, well, you know, the dollar is a toxic currency. And they go, what? And I say, well, what do you think our Zimbabwe monetary policy is all about with QE and the bond purchase program that's unsterilized? And they say, well, I thought that was stimulus. And I say to them, well, other people think you're smart, but I don't. I think you're an idiot. Now, we're seeing a real important phenomenon right now where the Treasury bond has become a global black hole. It's sucking in junk bonds. It's sucking in foreign currency like Bangladesh or Brazil. People are leaving those currencies and buying dollars. Why? Because their currency is falling. It doesn't mean their currency is worse. It just means that the system is breaking down, started by the dismantled Petro-Dollar phenomenon, causing the dollar to rise. And what happens in little Bangladesh when their currency falls because the dollar rises? What happens in Brazil when the real falls because the dollar rises? All their import costs go up.
Yeah, hyperinflation.
Starting with energy. Right, the hyperinflation, starting with their energy costs. So we're seeing a fleeing of money from what I call working capital. Companies are closing down their equipment, their shops, their plants, their businesses. They're liquidating their equipment. They're putting them in mothballs and warehouses. And with the money that they sell for all this capital, or money that they sell for, say, they held a bunch of foreign currency, but not anymore. They're going to hunker down. All together, let's hunker down into the Treasury bond. Isn't that the safe haven? It's the last safe haven. It's the last asset bubble. And I'll go so far as to say it is the grandest, largest, most magnificent asset bubble in the history of mankind. I was told back in 2006, 7, and 8, gosh, you know, Jim, I think this housing bubble is the last bubble. When the housing market goes, I think the whole US dollar, the Treasury bond, and everything goes to hell. And I said, no, we got one more bubble left. And they looked at me again and said, what, are you crazy? And I said, no, we got one more bubble left. And they said, what, gold? I said, no, the Treasury bond. When everything breaks and the tangible economy is wrecked, everybody's going to be hunkering down into the safe haven Treasury bond. But don't worry, we'll wreck it. And now we know how. QE, unsterilized bond monetization program. I say we're not in QE 3 now. We're in QE 176. We're in QE to infinity. You know, here's some of the recent elements of QE, because it's really quite interesting. We had Operation Twist in 2012 and 13, and few knew what that really was. It was the Chinese dumping their 10 and 30-year bonds and trying to buy 1 and 2 year treasuries and other short maturities.
That's correct.
Yeah. That was to get out of the 10-year. They didn't want to wait 10 years. They didn't think the system had 10 years. Okay, then we had another important event that took place in the last couple of years. It was kept very quiet. It's called the BLICS. Belgium, Luxembourg, Ireland, Cayman or Caribbean, and Switzerland, the BLICS. Well, little known fact, and it's certainly not in the New York Stinking Times, or the Wall Street Stinking Journal, or the Barron's little stink rag, but the BLICS, those 5 countries have as much Treasury bond purchases since June of 2012 as the Federal Reserve. I'm talking about $800 billion worth. Why isn't that financial news?
Should be.
It should be. Obviously, it should be. All right. So there are a number of significant QE events that signal the end of days. And the last one, glad I have my little notes here, the last one took place about 4 or 5 months ago. The U.S. decided, let's put out propaganda that QE is not going to increase on its volume. It's very steady at $40 billion a month. Well, that's a bunch of bullshit. It's really more like about $200 billion a month, and maybe 5 times that if they count derivatives. But they don't. So what does the U.S. government do? I think this was back in November or October or so of 2014. The United States put a gun to the Japanese government's head and told them, you're going to convert your entire $1.2 trillion worth of Japanese pension funds and convert it into treasury bonds. All right, well, that's QE for you, and just a different coat on it, a Japanese coat on it, whereas the one before that had a Blix coat on it. So we got all these different shenanigans going on to mask and conceal the fact that QE is ramping up its volume in a very big way. We enlisted 5 little nations in Europe to do our QE bidding, stole the Japanese $1.2 trillion, and what was the Japanese response? They didn't say, hey, wait a minute, we're going to war. That's $1 trillion you just stole. No, they said, we're going to go to QE on an infinite volume basis. What they wanted to do is replace their pension fund, and what they did in the process of replacing it was to put pretty much a millstone around the Japanese yen currency exchange rate. It fell. And now they've got an inflation problem, stuck with a recession. They've got stagflation in Japan, and it's ugly. So we're really late in the game here, and the commodity's falling, the oil price. When you see the oil price go down on a given week or month, just say to yourself, whoa, the dollar's dying. And so is the tangible economy, because money's coming out of it and flying into treasury bonds. It's the last asset bubble.
You know what's interesting, Jim? Because I was having this conversation with a friend and colleague yesterday about the dollar, and I went back and looked at a graph of the dollar going back to the mid-90s. And if you look, right before every crisis that's been brewing beneath the surface actually comes to the surface and erupts, and this starts with before a long-term capital blew up, the dollar has almost a near parabolic rise, and then it craps out. So, I mean, I think that kind of just sort of puts your analysis here to the test of history and confirms it.
Yes, and it's because the derivatives behind the scenes are being broken. All right, let me give you an analogy. You've got a building under construction. You see all the different steel beams, the skeleton system. I call them Tinker Toys. They put together all the steel beams. They put them with these gigantic nuts they're like, an inch and a half, 2 inches in diameter. And it takes men, many, many minutes to screw on the nuts for these steel beams. Now imagine what happens if you have partial construction on some of the floors, and they're not exactly occupied and going into business, but they're constructing the walls, they're constructing the floors, they're putting in the stairwells, they're getting in all the different works for the shaft for the elevator. Everything's coming into place here in stages. Well, what happens if you just take apart all the steel beams on the first 5 floors? Everything falls, and it's in full view. The difference with what we're seeing now is that derivatives are not within full view. They're visible only to a certain bunch of well-prepared and schooled veteran types. That doesn't exactly include me, but I'm on the edge there, and I've got some really smart friends like Rob Kirby who fill in the blanks on what I don't comprehend. And, sometimes I don't even comprehend some of his detailed explanations, but I get the gist of it. And I sometimes write him back and say, well, here's how I would describe what you just said. Am I getting it right? and I'm putting it in, somewhat layman's term, but somewhat financial engineering terms at the same time. We're seeing the dismantling of the system. And, it's not just the structure is falling apart that causes this artificial demand for dollars and liquidation of derivatives. It's much more than that. It's the secondary feedback loop effects, like I like to point out, Bangladesh, India maybe, and Brazil. They see their currencies falling. It's causing damage with inflation domestically, and the safe haven is pursued by the loose change and the heavy wealth. If you're a rich family in Bangladesh, you are damn well not going to leave your money in their currency. You're going to move it into the dollar, which causes additional upward movement in the dollar. We're not going to see the Treasury bond get trashed. It's not going to happen. We're going to see a lot of pressure on it. We're going to see, for instance, I think a lot of foreign nation banking systems begin to abandon their treasury bonds, treasury bills sitting in their banking system as reserves. I like to point out South Korea. I mean, they've got over $100 billion worth of treasury bonds sitting in their banking system. Do you think they want their savings to be undermined by QE? No, they don't. I'd like to point out one of the ugliest features of QE in the United States application, U.S. Fed. It's unsterilized, which means they don't remove, if they want to inject $50 billion one month in dollars, they don't remove $50 billion from the banking system to make room for the new treasuries. No, they just add $50 billion like Zimbabwe did. We got a third world monetary policy that we're calling stimulus. The only stimulus it provides is to the Wall Street portfolios. It allows them this Wall Street hidden backdoor bailout. They're dumping their treasuries on the Fed. So the Fed's got this $4.5 trillion balance sheet. So they're wrecking their own balance sheet. I get a lot of really dumbass comments coming to me from followers and sometimes from clients. They say, when do you think the Fed is going to hike rates? I think they're going to do it this year. And I say they're not ever going to hike rates.
Nope.
For three real simple reasons. It would torpedo their own balance sheet of $4.5 trillion. And I think the majority of that is sitting in treasury bonds. So they would kill themselves. Then it would torpedo the Wall Street portfolios that are loaded with bond carry trade. By that I mean they've got lots and lots of borrowed free money at the 0%, and they're investing in the 10 and 30-year bonds. And they're loading on leverage with futures contracts, and all that gets destroyed by raising the interest rate. I don't think so. And the last thing is all this demand for treasuries. Notice that there are almost no buyers, no demand for treasury bonds. And you got $1 trillion in new supply every year of treasury bonds. Well, what happens to price if demand goes away and supply is huge? Price should go up. It doesn't. Price should go down. I'm thinking of bonds or QE. No, if you got no demand and you got huge supply, it's like you got something that nobody wants and the price goes down. It's like a foreclosed house. The price goes down. So you go down rock bottom in price from a normal market. Well, why isn't the treasury bond going down, way down in its principal value price of bond, which means very, very high interest rate? The U.S. should have, for its government debt, should have 10, 12, 15% on its treasury bond debt. 10, 12, 15% because we look a lot worse than Greece. But we use QE. Now, this is the third reason why they're not going to raise interest rates. The artificial demand for treasury bonds comes by means of interest rate swap contracts. It's another kind of derivative. I think it's the biggest kind of derivative. And what they do is they take free money, 0% money, and using a complex sequence of swaps involving the cash bond versus the coupon bond, they do a complex sequence of swaps to convert the 0% shorted treasury bill, and convert it into a long-term treasury bond. So what they do is they make the free money that's associated with the 0% treasury bill, and they convert it into a purchase of the 10-year treasury bond. All that gets destroyed. Like the entire first 5 floors of the steel beams are removed for treasury bond demand if the Fed raises rates. I'll make a very simple comment here. Conclusion. The Fed will raise interest rates only if they're planning to scuttle and destroy the entire dollar-based financial system. They might do that.
I agree with that, Jim, and I've actually been writing that intermittently on my blog. I completely agree. And it's amazing how, what happens if the Fed were to raise interest rates even, an eighth of a point, let alone a quarter of a point. It's amazing, that, people can't play the tape through and try and understand what happens. And it just shows you the power of the propaganda that's going on in this country.
If they did a 1/8 point hike, the reason the damage would be so bad, the reasons are 2. You've got leverage in the system. Now, I mentioned the bond carry trade by Wall Street firms. They're using free money. You can't get free money to buy a car or home, but Wall Street can get free money. I'm talking about 0.25% money. They take the 0.25% money and they buy treasury bonds, and they earn, let's just say it's 2%. 2 minus 0 is 2% on the spread. So they're making 2% money without any leverage. They put on the futures bond leverage, it's 25 or 30 fold, and they're getting 50% return on their money. Okay, all that gets destroyed. So the 1/8%, just think of what happens when you multiply it by 30. You get a 3 to 4% effect on their invested money within the bond carry trade. It is a big deal. You've got to multiply it by the leverage that they deploy in their financial system. The second reason the 1/8 point means so much is that big players regard a first move as the first of many. Because you look back to the past in the Fed, and every time they do a 1/8 move, they do 7 more. And multiply the 7 more by the 30-fold leverage, and you get, very big numbers for your damage. So that's why they're not even going to do 1/8%. Haven't we been through this before with the taper talk in the summer of 2013, where the morons took the bait and said, oh gosh, I think the Fed's going to raise rates. Why? Because they don't know anything about the derivatives. They don't know anything about the bond carry trade. They don't know anything about the interest rate swaps. In other words, they don't know anything. This 0% is causing some real big damage. I've talked about the capital destruction. You close down marginal businesses that don't make any money, and what do you do with all the equipment in there? Well, you put it in a warehouse, and you got to pay for that too. Or you try to liquidate it, and that just makes your machines go down in price, in value. Well, there's another side to the wreckage, and that is to all the different financial structures out there, financial firms and funds that are managing money. I'm referring to the insurance firms and the pension funds. The pension funds can't make money in order to cover their pension awards, pension payouts. So now the pension funds are starting to sell their nut, sell their core. That's not good. The insurance companies cannot make money on their treasury bonds to pay out insurance claims and awards. So they're starting to sell their nut too, based on the treasury bonds. So, and then you've got, John Q. Public, like my father, who's got an enormous sum of CDs in a bank. And I ask him once in a while, what's the high? You got several CDs there, Dad. What's the highest rate you're getting? And he said, well, I still got one that has 2 or 3 years left that we put on 15 years ago, and it's getting 6%. But you're right. Most of them are getting 1.5 and 2 or less. I said, okay, well, how do you feel about that, Dad? Do you feel like you're being betrayed, not getting any money for your hard-earned CD? And he said, no, I'm pretty busy.
Oh, welcome to America.
The hyperinflation that we're seeing is financial, and it's going to completely wreck the stock and bond market. It's already wrecking the bond market, and the cracks are slowly coming into view. Shall we talk about the demise of the dollar as it applies to the bonds, you guys?
Yes, please do.
These are not real visible. I mean, I use my brother a lot as an example in these interviews, and one reason is that he never listens to them. And he's got a bachelor's degree in economics. He's also got a double major bachelor in political science, which just means one thing. He took way too much economics and political science courses. Way too much, way too many. And didn't get a proper education. Didn't take enough mathematics. Didn't take enough physics or biology. Can you say Monsanto, GMO foods? Didn't take enough physics. Doesn't know jack shit about the Earth's magnetic fields or anything. But curiously, he doesn't even know what fascism is. Political science doesn't know what fascism is. Economics and doesn't know what gold is. Okay, we got some structural problems now with the Treasury bonds. Before I get into the side broken elements, I'll just say that years ago there were boasts that the most liquid and highly traded financial instrument in the world was the U.S. Treasury bond. And it was true. Enormous volume. You want to dump $1 billion worth of Treasury bonds? Hey, you don't need to spread that out. Just put it on in the course of 2 days, and it's not a problem. The market's huge. The market can absorb that because it's a form of legitimate savings and a legitimate, real safe haven. But something's happened in the last 2 years. The volume has gone down 60%. That's 60. That's 50 plus 10. 60% volume decline. Why is that? Because we're in the 5th year of QE. That's why. And there's significant structural damage. So imagine you're in just, say, the 2nd or 3rd year of the Treasury bond QE program, and you're holding a lot of Treasury bonds, and you're not locked in like, say, a pension fund or an insurance company. You're not locked in. You've got the discretion. And you decide, well, gee, if QE is going to be buying all these bonds, then I'm not an idiot. I can see that they're eventually going to destroy that market. So let's sell them our bonds. And if we wait a little bit, we might get a little bit better price as the rate goes down and the principal goes up. So in the course of the last 4 or 5 years, there have been fewer players. Now that's at the micro level. I'm talking about, XYZ Corporation, and they've got $1.5 billion in reserves in their corporate treasury. Well, they're not sitting in treasury bonds anymore. They got rid of them. Who they sell them to? The Fed. How do you think the Fed accumulated $4.5 trillion on their balance sheet? They bought it all up. The Fed is the market. Now that's the joke. But there's a macro factor in there also. All kinds of foreign nations are not buying treasuries anymore, and many of them are actually selling on a net basis. China, for instance, sold $135 billion worth of treasuries in the first 3 months of this year. China sold 125, I might get the 2 quarters backward, but in the last 2 quarters, they sold 125 billion and 135 billion. That's $260 billion worth of treasuries. And I read this morning that the Chinese have sold $520 billion worth of treasuries in the last 12 months. Well, that's a pretty hefty pace of almost, well, actually they're slowing their pace down if it's only 130 per quarter. Maybe they don't have many left. So you have foreign governments and their central banks dumping treasuries. You don't have very many legitimate buyers in the room anymore. The Fed has become the market. Okay, here are some of the stress, and I call them ancillary markets. The repo, the repurchase program, it has a negative rate once in a while. Why is that? Well, if you want to discourage financial firms from dumping, even on a temporary short-term basis, a bunch of their treasuries, you want to discourage the companies from dumping their treasuries. Well, how do you do that? Instead of offering them a rate, you start charging them. That's what's going on. Okay, second one is the dollar swap. Foreign countries sometimes run low on their dollars sitting in their banks in required redemptions. Let's just say a French bank has a whole lot of treasury bonds coming into the bank, and they need the bank's trading offices to redeem them. Well, they don't have enough dollars, so they do a dollar swap. The other example is this French or Italian or Spanish bank might have, or German, might have a big slew of Petro-Dollar derivatives coming through the window. Pardon me. And they don't have sufficient dollars to pay them out on a redemption. So they use the dollar swap. Well, unfortunately, the Fed has realized, well, there's way too much volume here in these dollar swap demands. How do you discourage a small torrent every week of demand for dollars at the Fed? Well, you start charging them. So you get a negative rate on the dollar swap. These have never happened before. There's never been a negative on a repo. There's never been a negative rate on a dollar swap. And gee, last I checked, we got 20 different countries that are charging a negative rate. They're charging a rate, in other words, a negative rate, for bank accounts. Why is that? Because people are moving money out of working capital and putting them into banks on the sidelines. We're seeing a death of the tangible economies. Okay, I'd like to make one final comment regarding repo, and it's ugly and insidious. It regards the reverse repos. Actually, I have 2 final points to make on this theme, general theme. The reverse repo. All right, so in a legitimate manner in past years, a financial firm would say, oh, we're short $20 million here. We only need it for 10 days. We can post some treasury bonds. And sometimes in the past, they would post some high-quality corporate bonds, like, big bank bonds. But let's just say they post treasury bonds to the Fed as part of a repo, and they would get a certain interest rate on their repo that they would buy back in 2 weeks or 4 weeks or whatever on a short-term basis. Well, this has been turned on its ear. The Fed is now saying, we're doing some reverse repos. In other words, we're putting money into the system without the collateral posted at the repo window. That's nothing but hidden QE. They're putting money into the system from treasuries, and they're not having the treasuries posted as collateral. That's hidden QE. Okay, there's another insidious thing going on, and that is failures to deliver on treasury bonds. And the Mickey Mouse explanation propaganda bullshit coming out of Wall Street and the Wall Street Journal is that, well, you know, we've got such incredible demand for these high-quality U.S. Treasury bonds. Everybody wants them. It's so hard to fill all these deliveries. What a bunch of shit! What they're doing is they're selling Treasury bonds at the Wall Street banks in counterfeit. They're selling Treasury bonds that, consider it like short selling, but not owning any to short sell against. Naked short selling of Treasury bonds. How do you improve the liquidity? At JP Morgan, Citigroup, Bank of America, Wells Fargo, how do you improve your liquidity and cash flow at your broken bank? You short the Treasury bonds and take in the money and don't deliver on your Treasury bonds because you don't have them. Failures to deliver in Treasury bonds means counterfeit, fraudulent short sales. This whole Treasury bond market is breaking. We've seen some convulsions in the last few months. We saw, for instance, a big move when rumors got too thick that the Fed was going to hike. I think it was yet another taper talk trial balloon. They saw the effect. They saw the interest rates went up. Bonds were being sold off, and they didn't like it. So they stopped talking about a Fed hike in the whisper mills of Wall Street, which are often coming from conference speaker podiums. Okay. Now, there was another event, I think it was in March, where the German government bond, the Bund, also suffered a convulsion, a big move in a matter of just days, caused a lot of damage. And the ignorant would say, well, gee, it went from 10 basis points to 80, big deal. Meaning it went from 0.1% to 0.8% in their 10-year bond. Big deal. What is a big deal? If you're a buyer at 10 basis points, suddenly you're looking at a big loss. I read a financial analyst report, an assessment on what happened in the German Bund and other like Italian sovereign bond markets. Collectively, all Europe suffered a $1 trillion loss in all their sovereign bonds in a matter of several days. Well, that's a big deal. I have one really smart source, and he tells me if you want to see a real big distress signal, it is in the bond market. It is the spread between the U.S. government Treasury bond and the German Bund. The spread between their two 10-year yields. Because when it gets big, consider it a euro death signal. And, we've had some hilarious things happen in the sovereign government bond markets. The one I like to point to is how in, I think it was April or May, April, I believe, the Germans announced they had a surplus, a government surplus. And in the surplus, they announced that, we're not going to be able to offer adequate supply to the German bond market. And with this, vanishing supply, the demand's going to come in. And by the way, some of the demand was from the Euro Central Bank, from Prince Draghi. With the absent supply, the continued flow of demand resulted in the German 10-year bond going slightly negative. And they don't like that kind of stuff. So the Germans themselves tried to reverse it. And they caused a minor panic that resulted in that big move from 10 basis points up to 80 basis points. So they stopped doing that. What's the moral of the story? If you don't have sufficient debt, you wreck the system. We've got a debt-based foundation for the global forex currency systems with the dollar as its leader. The dollar never has this problem because the U.S. government always has $1 trillion in debt. I made a forecast back in 2008, and of course I was called an idiot. I'm always called an idiot on my correct forecasts. I was told, Jim, you're an idiot. You're saying that we're going to have $1 trillion deficit every year after 2008? Are you stupid? Are you taking stupid pills? And I said, no, I'm communicating with a stupid person. Now, in 2014, we had the government, U.S. government, coming out and stating that they had a $550 billion deficit for the year, and it was later corrected to $1 trillion. That's a big correction. Now they've got the same horse shit coming out saying that the federal deficit is down toward, $480, $500 billion, and it's because we got a recovery. And it'll be revised later to be $1 trillion. What they're doing is they're putting on seasonal adjustments to annual data, which makes no sense. You don't have seasonal adjustments on a full cycle, guys. Now, it brings up another point regarding, the Germans didn't have adequate debt to supply, debt securities to the system, and it caused problems. Now you're hearing the morons in the West, principally New York and London, state that the Chinese could not possibly make their RMB currency a global reserve because they don't have adequate supply. They don't have enough debt. Well, it will be, I think, an intermediary global reserve to push out the dollar. And how? Because all the countries of the East, the BRICS and their 140 nations in their alliance, there's 117, I lose track. The Eastern nations are going to demand that trade settlement. Just take, for example, Walmart brings in several ships worth of goods from Asia, principally China. They need to pay for it. The Chinese are saying, well, you got to pay in RMB. Okay. And you got other nations of the world like Brazil, and they've got their shipments, and India, they've got their shipments, and they're going to want RMB. So I don't give a rat's ass that China doesn't have adequate debt from their government debt security market. I care that nations of the world that are producing things are demanding RMB from the United States and other importing nations that are basically broken, like Western Europe. And then you're going to have, additional intermediary steps toward gold trade notes used as letters of credit. And this is the crowning blow. The big change coming will be when nations say, no, we don't want treasury bills anymore. We demand gold trade notes as letters of credit. Walmart, sorry, but you've been paying us the last year more on RMB. Now we want gold trade notes. And I think that's when the RMB is going to be converted into a gold currency to simultaneously lubricate the process and transition into gold trade notes used as letters of credit.
Sorry to interrupt, but that brings us to the end of part 1. And if you will click the screen, it will take you automatically to part 2. And thank you once again for listening and watching.